Texas Roadhouse released their earnings report for the fiscal year of 2024 and their shares dropped by 2% on the day. I want to take a look at this company and see if it is looking like a buy in today's market. Starting off, the business is made up of company-owned restaurants and franchise restaurants, with the franchise restaurants accounting for 15% of total restaurants in the company. The company operates 3 different businesses: Texas Roadhouse, which I'm going to call TR, Bubba's 33, and Jaggers, with TR being the vast majority of the company, representing roughly 90% of the company's restaurants. TR has produced a 12% gain for its shareholders over the last year. However, it's seen a 14% correction from its all-time highs over the past few months, while business fundamentals continue to increase quarter over quarter. Now let's take a look at business fundamentals. Revenue has been growing since its IPO in 2004, excluding COVID, and it's continuing to hit all-time highs of $5.37 billion. This represents a growth rate of 16% year on year, which is accelerating compared to its historical growth of 15% on average over the past 5 years and 13% over the past 10 years. Now looking at operating cash flow, we can see it's currently $753 million for the year of 2024. It's increased massively during 2024 and has grown by 33%, which is way above the 10-year average of 14%, and on a side note is not majorly skewed by COVID. Now taking a look at CapEx, we can see that management is actively reinvesting into the business, with CapEx at $354 million, which is projected to increase to $400 million throughout 2025. This rise is primarily driven by the plans to open 30 new restaurants. Additionally, the company maintains a strong cash position of $245 million and has begun the year by using this cash position to purchase 13 franchise restaurants for $78 million whilst not incurring any debt. Now taking a look at the operating cash flow of $753 million, and we deduct that by our capital expenditures of $354 million, we can calculate our free cash flow, which is $399 million. This is also an all-time high, representing 83% growth compared to last year's data. I would like to note that the increase is due to 2 separate activities. First, the free cash flow margin has grown to 7.4%, which I'd like to point out is around average for this type of business. And secondly, CapEx has not grown significantly, and proportionally to revenue, it's actually decreased by 11%, which shows the business is not reinvesting as much as it actually could. For dividend and share buybacks, we can see that the free cash flow is currently being deployed by management to pay a dividend of $2.74 per share, which is currently a 1.58% dividend yield. This dividend has been paid out since 2011 and has grown every year since, and has a dividend growth rate of 15% for the past 10 years. The company has been buying back shares and has bought back $79.8 million worth of shares in the fiscal year, which is further increasing shareholder value. The Q4 report also shows that the board has authorized a $500 million share repurchase program with no expiration date. This is roughly 4% of all shares outstanding, and if past performance is to be an indicator of anything, they may repurchase this over the course of 3 to 4 years. Finally, moving on to the balance sheet, while the business has no debt, their current ratio is 0.51, which isn't exactly favourable. However, this isn't a major cause of concern, and this is mostly due to accrued liability and accounts payable, which is goods and services that the business has already received but still needs to pay, which is very common in the restaurants industry. This also allows them to receive the goods that they can sell and pay off later. This ratio also includes the $89 million spent on acquiring the 13 restaurants. Taking a look at the business itself, we see that the business is showing no signs of slowing down, and that they are creating new stores and letting franchisees branch out internationally, with 57 franchise international locations currently. This allows the franchisees to front the risk without the business taking on additional costs. Additionally, the company is expecting 30 new company-owned restaurant openings in 2025, in addition to 10 franchise restaurants. This shows the company is maintaining good expansion and continuing to scale. As mentioned previously, the company also acquired 13 franchise locations, which further adds to scaling, as the company will now earn 100% of these stores' revenue instead of 4 to 5%. But also because comparable restaurant sales increased at 8.5% at company restaurants compared to 7.4% at domestic franchise restaurants. So the company operated stores perform better at driving sales and with this logic should increase the revenue produced in these restaurants. Darden Restaurants would be one competitor of Texas Roadhouse, and I want to compare the two to see how much better or worse Texas Roadhouse is in compared to its competitor. Darden's market cap is double that of Texas Roadhouse, and Texas Roadhouse's stock has double the growth when compared to Darden's over the past 5 years. Also, looking into Darden's revenue, it's grown at a compounded annual growth rate of 6% compared to Texas Roadhouse's revenue of 13.9%. I'm going to be using operating cash flow when looking into Darden, as it's the best metric to use when looking into restaurants. I'll be looking at this over the last 6 years to take into account COVID. The stock has compounded at 6.8% over the last 6 years, with an average price ratio of 13.71 compared to Texas Roadhouse's operating cash flow, which is compounded at 12.37%, with an average price ratio of 14.61. This means that using these metrics, it shows that while you are paying slightly more for Texas Roadhouse, they are vastly increasing their operating cash flow, which can justify the higher price. Free cash flow margin has also not grown for Darden, whereas Texas Roadhouse has managed to grow it annually at 5%. I would like to point out that since Darden's revenue is larger, and it still does have larger free cash flow margins, it's naturally larger that they have more cash to give back to investors in the form of dividends. However, Darden has double the shares outstanding that Texas Roadhouse has, and Texas Roadhouse is buying back shares at a larger rate, providing more value for shareholders. Looking forward at the potential stock price, we will use operating cash flow as our metric. With the latest quarter, the growth for the past 6 years is 12.3%. However, the company seems to be accelerating in margins and growth, and I believe a metric growth rate of 14% would be more appropriate. I'm going to leave shares outstanding the same. While they do have a bigger budget to buy back shares, there's no real guarantee that they will accelerate their repurchasing of shares. We will use a dividend growth rate of 11%, which is the latest increase in the most recent quarter. However, it is below the 5-year average of 15%. I'll put the price ratio of 15, which is below the latest price ratio, but it's higher than the 5-year average. But I think this is justified with the accelerated growth. Finally, we'll use metric override to put in our latest numbers from the most recent quarter. Here we can see that the company is currently 30% below fair value and could return a compounded annual growth rate of 16%, which is amazing, and shows that the business is currently undervalued in the current market. Overall, this company seems to be a high value company and seems well able to grow exponentially in the future. However, I would like to add that their management is slightly unorthodox, and this would hinder my conviction for the stock, although what they are doing seems to be working quite well for them and their shareholders, and I can't argue with that fact. Finally, this stock does seem to be trading quite a bit below fair value and could yield a solid return for investors.